Welcome to IG's Commodity Chat, the first in a series of 3 half-hour shows covering the commodity markets. Today we're concentrating on the precious metal space. We'll be looking into the influence of the strong dollar on the price of bullion, the latest big central bank purchases, and how low demand is influencing suppliers. Well, joining us today around the table is Simon Popple from BrookfieldCapital.com. Simon began his career in corporate finance, but started Brookfield Capital in 2008 as a capital raising business. Simon's been involved with the Metals and Miners Journal, Money Week and Gold Speculator. Also with us around the table is Ross Norman, Chief Executive of bullion dealer Sharps Pixley. Ross began his business career with Sir Clive Sinclair, but quickly moved on to Johnson Matthey as a gold refining manager, and then as a gold trader at NM Rothschild and Sons, and later the senior dealer in physical bullion at Credit Suisse. Welcome, gentlemen. Back with you in just a few moments' time. During the show, we will also hear the opinions of 3 analysts with their own individual views on the gold sector. A guest here to help you understand these markets, trade the markets and answer your questions. To send your question in, really easy, just send it via Twitter using the hashtag IGCommodityChat moniker, and we'll put them to our guests. So now the precious metal space is dominated by gold. However, silver is also in the group, as indeed is platinum. There are others, but these are the most heavily traded, with gold being the most precious in terms of current price. But for the purposes of this commodity chat, we'll be looking primarily at gold. Let's take a look very briefly at where our guests stand on this. Simon, to you first of all. Welcome. It's good to have you on the panel. How do you see the market at the moment?
Well, I think gold is going through some very exciting times. We're in uncharted territory in a number of areas. We've got Brexit, we've got huge debt in the US, we've got the Fed rate going up, and gold is typically a sort of safe haven asset. So at the moment it doesn't seem to have reacted that much to all these events, but I think 2019 could be very interesting.
Ross, from your position at Sharps Pixley, how do you feel about things?
Well, disappointingly, really, it kind of chimes with Simon, really, which is to say, I mean, in a word, I'd say currently gold is unloved. Physical flows are probably the worst I've seen for 20 years or so. And that's, if you're a contrarian, not a bad thing. But there are signs that things might be beginning to change. Technically, we seem to have found a floor. Year to date, gold is off 7%, and conversely, the dollar's up. I think a lot of gold's problems relate to the dollar strength that we've seen for much of this year. That might be about to change. Okay, all right. Thanks indeed, gentlemen. We're back actually with another view in just a few moments' time, very much the contrarian to what we've heard so far here today on the show. Now, before we get deeper into the discussion, there are a number of ways to invest and trade in precious metals. You've got bullion, gold coins, ETFs and stocks. Let's hear more. How to trade and invest in gold. As with other commodities, gold bullion can be traded in several different ways. As a commodity, through the spot or futures price, buying and storing physical gold, gold ETFs, and stocks of gold producers and explorers. The spot market. This is where professional traders and dealers buy and sell gold for more or less immediate settlement. It has no specific location or trading platform. Instead, it's governed by a set of common rules and standards that have to be followed, that indicates pricing, payment and delivery. The importance of the spot market is that the price set is the price of gold that influences other investment and trading vehicles that retail market participants can get involved in. This includes the price that physical bullion changes hands. The most common way is either gold coins or finely weighted gold ingots. When making a purchase, ensure what is being supplied is genuine and then ensure its safety. There are companies through which you can buy gold bullion, which will then store it, but you have to pay a premium for the service, an ongoing storage charge, and then another premium charge when you sell. Also, when you sell bullion, either gold bars or coins, there is a tax to pay through capital gains. That is, unless you buy British sovereigns, which are considered currency and attract no capital gains tax. Gold ETFs. These are part of the popular exchange-traded products that are around, and they are funds that track the price of gold. While there is an annual fund administration fee, because there is no ownership of the underlying bullion, there is no marginal cost for the purchase or sale of units in the fund. Finally, shares in gold producers. These are a favoured way for many to invest or trade in the gold space. The main advantage of buying gold shares is that any move up in the gold price magnifies the added profit a gold producer makes. If a gold producer has a cost per ounce of $900, when you buy shares in the producer and the gold price is $1,000 per ounce, the profit is $100 per ounce of gold that's mined. If the gold price rises to $1,100 per ounce, anyone holding the underlying metal has a 10% uplift. However, the gold producer has doubled its profit margin. Clearly, if the underlying metal falls by $100, holding gold will only see a 10% drop in value, where the company makes no money at all on each ounce it pulls from the ground. Like any investment, a considered and balanced approach is always recommended.
So there's some of the ways you can invest in gold, and we have here right beside me on the right hand side Simon Popple, who is an investor, and I've got the gold bullion dealer Ross Norman from Sharps Pixley. Ross, to you first of all, it always surprises me as to how small a piece of gold can be to make a substantial amount in terms of sheer weight. As a dealer, you brought in something which to me looks like just a small bar of chocolate.
Well, the first thing that strikes you when you hold it is the density of it. Like, that doesn't come across looking at it, but it is twice as dense as lead. Absolutely. And as a store of value, the key thing about this is it's portable. Now, what I'm holding here is a kilo bar of gold, 99.99% pure, a value of roughly £30,000. So that's the average UK wage right there in my hand. But you can see these can be put into a safe deposit box, stored away. So as a portable form of wealth, yeah, it's gold.
Yeah. The point about gold is the fact that we are actually, as a globe, producing more of it, aren't we? It seems to be rising and rising.
Yeah, I mean, there's a lot of talk about peak production, and unfortunately we probably won't know until we sort of got there. But what is interesting is that the M&A market seems to have picked up, which suggests that the big boys, the major players, are more interested in acquiring the juniors where there is a known resource, rather than spending their own capital, trying to find it, which may indicate that it's proving very difficult to find.
I think we've got a chart here actually showing how the global gold production. This goes all the way back to 1840. It puts into some sort of perspective. As a dealer, when you get a continuation of this rise in production, surely it does have a depressive effect on the price.
Well, the supply side is a deeply unsexy part of the story, sadly. Investors rarely allude to it. They should do, because if you take a long-term view of gold, and that's where you should invest in it, fundamentals are important. On a tactical basis, whether there's another tweet here or geopolitical tension there, doesn't really matter in the long term. The nice thing is, for investors who take gold seriously, they take a long-term perspective of 5 to 10 years. And that's quite noble. That's noble because we know roughly how much gold we'll be producing in that period of time. So it doesn't tend to drive it. The key point about production is that we do seem to be plateauing, as Simon says here. We do seem to be plateauing, which is helpful. Indeed, SG and Goldman Sachs suggest there's only 16 years worth of gold production left. We're at peak gold.
But the thing about that is, though, surely, is the fact that the way in which we're now digging out of the ground, we have new technologies, we have different ways of doing it, and there is a lot more gold out there, but at the moment it's uneconomic at these current prices.
Uneconomic currently for about 10% of producers only. If gold fell back to around the $1,000 level, you'd find about 50% of gold producers will be producing on an all-in sustaining cost basis. In other words, on a risk-reward basis, there's a limited downside on gold because of the sheer cost of producing it. Gold's done rather well over the last 20 years. It's gone up 12.5% year-on-year compounded, but serve costs. So you've got a floor there, and gold could come off a little, but how high could it go to? That's really what's interesting investors.
Yeah. Going back to this business about the production, where is the demand coming from that is soaking up this production at these prices?
Well, central banks have become net buyers of gold recently, and if you look at the charts, India, China, Russia, Turkey, the demand is really going through the roof. And if that continues, and especially if other countries hop on that bandwagon, then I think that particularly central banks, they really are going to be becoming very active in the market.
You said if. Big question. Why would they stop? Or what? No, let's ask first of all, why are they doing it? Why are they calling so much gold?
Well, You don't really know. I mean, I think that a lot of central banks want to increase the percentage of reserves in terms of having reserves backed by gold, and typically that's around gold accounts for about 20% of reserves, and emerging markets were way under that level for quite a long time, so they have been increasing that.
Part of the answer might lie in a parallel story, which is the repatriation of gold. You saw the Bundesbank taking its gold back. There are discussions currently about Australia, other nations, Austria, taking their gold back from other major repositories and vaults around the world. In short, I think there's a degree of concern about the macro environment. How bad can it get? Well, I don't know. But from their actions, which is to say that they're buying gold and taking it home, tells you that there's clearly some level of uncertainty amongst the official sector. Just to take a bigger picture view, rewind 10 years ago, central banks were net sellers, conversation of 400 to 500 tons a year. They were contributing gold into the supply sector. They now switched through to net buyers of between 400 and 500 tons. That's a swing of about 1,000 tons on a market where we produce 3,200 tons a year. So it's been quite a big swing factor. Central banks are demonstrating by their action that they're concerned. Interestingly, I've just come back a little while ago from the London Bullion Market Conference in Boston. The very first session was a central bank one. Normally it's rather dull. The comments are rather nuanced, and you have to work hard for your vitamins out of this session. But they were very strong in their rhetoric. They said, look, we like gold. We're interested in gold and we'll be buying more. And that took us by surprise. No numbers added to that, just a very positive view. The following session was the financial sector, the banks. And we said, sorry, chum, you're off the record, we're off the radar. You're unloved. I mean, you have been for some time. We don't see ourselves in this session. On that platform, you had $1 trillion, 148 billion, and $8 billion in fund managers. They said, you're not in play. So it was a rather strange conference, this very mixed view that came out. Perversely, at the end of the conference, the entire audience was asked to vote on where we saw gold in 12 months, and it was $15.32 an ounce. As one of the most bullish forecasts I've ever seen, notwithstanding the incredibly bearish comments coming out from hedge fund managers.
Well, if we bring up a gold chart, in fact, we can take a look at it in the context of where we are at the moment, and that would take us back to levels we haven't seen since, I think, April 2013. I mean, that's a heck of a difference between where we are, but presumably that does include potentially some catastrophic event, economically or otherwise.
Well, no, you weren't permission to give your rationale for why you think it would go higher, but certainly the biggest bull factor in the conference that we saw was the commentary from the central banks. You might also add, and I brought a chart along a little earlier, you might also add that speculators are net short gold, which is almost unheard of. If you're a contrarian, you rather like that. If they're short gold, they're likely to want to cover that either by year end, a profit's not a profit till it's taken, and bonuses and all that. There's a likelihood that they'll want to cover. So tactically, this isn't a reason for buying gold in the long term, but tactically, there is scope for that short covering rally to happen. If gold should get above 1240, and we're currently nestling up against that 1228, 100-day moving average, if we got through 1240, I think you could see a bit of short covering rally taking us to 1275 or so. This is a tactical gain, and not one you should bank on. Understand gold's about the long term, but there's a little win there possible for gold traders.
Well, this is the thing, isn't it, about trading gold is fine, you get in and out and whatever from the investment point of view. In the long term, there is no value in this. It is a piece of metal. It's a little bit of gold, whatever. Gordon Brown said this, I think, when he was selling off the famous sell-off of London gold in the London vaults, that he wanted to use the money better in the economy. That's the whole point of this, isn't it? That the money should be used to do better and more efficient and more beneficial things.
Absolutely. Well, I think actions speak louder than words. And if you look at the central banks and what they're doing, and the behaviour in the market towards gold as a safe haven asset, there are people who you perhaps expect to have that view, but they're doing the polar opposite, and they are actually buying gold, particularly physical gold. So it's going to be very interesting to see how this plays out, and that's why I said at the top of the show that I think that 2019 is going to be a very interesting year.
We're coming on to your point, for a non-gold bug listening to us talking and watching, they'll be wondering, looking at that gold bar, but why that? Why that element? It's only a piece of inert metal. There are 118 elements in the periodic table. Why number 79? Well, perversely, if you remove those which are too abundant, which are gases or liquids, or too rare, or have too high melting point, they all kill you, radioactive ones, actually you end up with 8 metals. 6 of those were only discovered in the last 100 years, the platinum group metals, leaving with 2 metals, gold and silver. Silver does corrode, of course. And it's not just me thinking that, looking backwards. When Marco Polo went down the Silk Road and he found himself in Japan, there they were using gold. In Europe we were using gold. In South America we were using gold. Relatively isolated communities had all come to the same conclusion that of all those 118 elements, there's only one which is sufficiently rare, holds its value, has high purity, and they all fell upon the choice of gold. So it's not a quirk of chemistry that we chose this one. It was common sense.
And of course, the attaching currency value to gold, as we used to do, did give gold some sort of validation.
Absolutely.
But that went when central banks started to withdraw
73.
from the benchmark.
Correct. 73. Yeah.
Let's talk. You mentioned silver. Let's talk very briefly about silver. How involved, Simon, are you as an investor in silver?
Less so, because it really is a hated metal at the moment. I mean, the ratio of gold to silver is around 86, which is huge, which means you need 86 ounces of silver to buy an ounce of gold.
Why has that happened? What is it that's expanded that differential?
It's very difficult to know. I mean, gold, I think, is from a sort of safe haven perspective, because it's so much more expensive, it's far easier or cheaper to store. And silver, I think when sort of solar came out and there was a lot of uses for silver, there was definitely a spike in the price. But I think that technology has meant that perhaps less silver is required for certain technology, and therefore, perhaps that's affected the price. But it's difficult to know.
I would concur. I mean, if gold is unloved, silver is positively disdained. Going back to the gold-silver ratio, if you ask Mother Nature to make your market, what is the ratio in the ground, gold to silver? The answer would be 15 to 1. Roughly what the ratio was in Roman times on the gold and silver current coins, 15 to 1, respecting nature. The typical average over the last 50 years has been closer to 50 to 1. At 85 to 1, it's telling you that either gold is overpriced, we don't think it is, or silver is massively underpriced. So your point that gold looks like a screaming buy is absolutely the case. But silver has a lot of headwinds. Sorry.
No, I was just going to say, actually, I want to quote Mike McGlone. He's a senior commodity strategist at Bloomberg Intelligence, and he says there are risks to this. Global manufacturing PMIs are likely to remain above 50, but are declining, and rising silver exchange inventory levels, which is another thing to suggest that perhaps maybe there is a risk to this silver price at where we are. But nonetheless, he does go on to say that at these levels around $14, we bring up the share price, the price chart again, you can see that we're at these lows that we saw back on the 2015, October 2015 level. On the basis that it is an industrial metal, if you see a wind down in global growth, then you're not really going to expect much demand for silver from certainly the industry side, and no one wants to wear it because you just said that it tarnishes.
And added to which, you can buy this investment bar without VAT. Silver attracts VAT across the whole of Europe. Right. So it's an investment medium, not in ETFs, but as a physical commodity, silver is deeply unappealing for a number of reasons. It has two faces, an investment medium and also as industrial metal, but it also attracts VAT. Who wants to pay 25% premium for an investment? Nobody.
Yeah. Okay, look, gentlemen, back with you in just a couple of minutes, and I'll also catch up with some of the questions we're getting in as well on on Twitter and also Facebook and YouTube. But as promised, I want to take a look at the other side. Not everybody is a gold bull. Earlier, we spoke to James Bevan from CCLA, that's the Church Commissioners and Local Authorities Fund, and he raised his concerns and explained a little bit more about his position. We also take a look as well at two other guests' views in the last couple of days about a couple of stocks that they are watching in the precious metals sector.
I worry about gold in the context of the linkage it has to other commodities, and if one was to look at a very long-term chart of gold relative to commodities, it's reasonably tightly correlated, and against that perspective, the drawdown in the gold price that we have seen that's disappointed some bulls, I think is entirely consistent with what we are observing in the commodities complex writ large. And I think that as global growth slows, then so we should expect the commodities to continue to be weak, and therefore I would not be a buyer of gold at current levels. And therefore, by extension, I wouldn't want to buy the miners because they are geared plays on the gold price.
I think that Randgold looks like an attractive stock at this part of the market cycle, and this is because a lot of the heat has come out of the gold market over the past 5 years. So Randgold, which used to trade at a big premium to the FTSE 100, is now only trading at a premium of about 20% as opposed to 90% over the past 20 years. So if you get a little bit of an uptick in the gold price, a little bit of fear about inflation, and maybe some economic uncertainty, then Randgold, with its low correlation to the FTSE 100, should be a very good place to park some of your assets for a more defensive play.
I do think there's a case to be made that we see relative strength versus other risk assets, and I think certainly looking into 2019, that's something I'm looking at. So if you look at something like Barrick Gold, but again, keep in mind the primary driver here for something like Barrick Gold, ticker symbol ABX, is going to be the actual gold price itself. So you can't really trade this with idiosyncratic risk. But if you look at this, again, just drawing some very simple lines to the technical on the charts here, you can see we're bumping up against plenty of resistance here, which I think ultimately this coiling below here is quite healthy, which could see a peak, a pierce back above there, and that would be quite constructive. You can draw, again, everyone can draw lines, but these are sort of the prettiest lines that I can come up with. You can see the red line there, that's your 200-day moving average. We're consolidating above there. If you want to get really technical and draw bull flags and those kind of pretty things, which are just consolidation patterns, yeah, it looks constructive. I don't want to buy it right here, but I think if a stock like this can get back above $13.50 or so, and it comes in conjunction with a better bid in gold, I think you have plenty of upside.
Well, there's a couple of stocks there that were mentioned by a guest in the last couple of days. Simon, first of all, as an investor, why should we be interested in shares of gold miners? What's the advantage of owning those over the physical bullion, which you can take around with you, and it's there in front of you, and you can put it in your pocket?
Well, I mean, with gold stocks, you've got the leverage to the gold price. So the costs, even though they may go up slightly if the gold price goes up because there's more demand for miners and mining professionals, generally the costs don't go up as much as the gold price. So what you have is margin expansion with these miners. So if you're bullish about the gold price, then you're sort of automatically bullish about the stocks.
Okay, all right, so that's a fairly straightforward explanation. Let's get back onto track with some of these questions that we've had in from clients. I want to go first of all to Ross, if I can ask you to pick one. Are gold prices being manipulated? The question is specifically about China. We've got a chart, I think, that shows the demand from both China and also Russia. I don't know if there's necessarily too much context in terms of this particular question, but you can see that Chinese demand has risen, not as, in fact, more so than Russia. This chart goes back to the year 2000. But are the markets is it capable of manipulation in this market, first of all?
Well, no conversation about gold is complete without looking significantly at China and its role within that. It's the world's biggest producer. It's the world's biggest consumer. Central to that story is the People's Bank of China and their gold reserves. Under the special drawing rights, when China was seeking to get its currency under the special drawing rights, it had to declare fully its gold reserves. And it did so, and it came out with a figure. Currently it's up at 1,842 tonnes, roughly a quarter of what America's got. What we believe is that China has stated it has sufficient reserves to get them through the gate to get their special drawing rights as required, but not so much as to embarrass others. What I mean by that is they don't want their currency to escalate too rapidly for trade advantage reasons. So there is a general belief that a significant proportion of Chinese production and imports are going on into the vaults of the People's Bank of China, and they're not declaring it. If I was asked, do they have bigger reserves than America's at 8,000 tonnes? My view would be probably. In fact, I would expect to be north of 10,000 tonnes. Which is a very significant number and a very different figure to the figure you showed on that chart there. Supporting that view, the market feels supported. On a dip, there's good buyers out there. It goes back to our early conversation about central banks. I believe they're acting Indian-like. If it's cheap enough, they'll acquire a little. They're not going to chase the market higher. If it's cheap enough, they'll buy it. Whether it's a Chinese central bank behind it, I don't know. But rewind, if I may, very quickly to 1999, when dear old Britain sold off half its gold reserves through an auction process run by the Bank of England. Who acquired that gold? Well, it's not widely known. I can tell you who they were. The Chinese.
Oh, really? Oh, right. Okay. In terms of price, they're buying at these levels. what level are they going to start selling at? Because going back to your 1,500, whatever it is for the price of gold, $200, $300 above where we are.
When will central banks start selling?
Yeah.
I don't think that they would and will. Your typical Western central bank has 65% of its reserves in gold. Your emerging nations, many of those we've talked about who are buyers, are down in single-figure percent of reserves in gold. They've got a long way to catch up. So I think that Western central banks have stopped selling gold under the Washington Agreement that we saw in the early 2000s, and emerging market central banks are very keen to acquire it. Diversifying away from the US dollar, absolutely, and it's being demonstrated by the tonnages we've seen recently.
Yeah, I think we've got a question in on the gold standard. I don't have that in front of me, but I'm being told we've got a question on gold standard. Before we do that, and while we're just bringing up that question, Simon, I want to bring you in to take a look at some recent evidence to suggest that there are now 200 people that think they own every ounce of gold that's available on the COMEX exchange in New York. My last interview on this particular subject was back in 2010. That was 90 people, but I understand that the historical average is about 30 people believe they own. What is this telling us, the fact that there's a massive leverage on gold at the moment, 200 plus people thinking they own 1 ounce?
Yeah, I mean, I think this is it's a rather daunting number. I mean, my sort of analogy would be, you go and pick up a car from a car showroom, and there's 200 people on the forecourt thinking they own the same car. If you're comparing paper to physical, clearly the paper market is very liquid and it attracts huge demand. But yes, I mean, I think it is a number that just seems to be getting sort of higher and higher. And I'm not sure at what point, people should worry about it.
Of course, we look at the gold price, and we've just been talking there about the gold price movement at 1,226. As a dealer, you obviously sell and buy gold off the exchange, don't you?
Off the price.
I mean, how much different is do people buy it from the exchange price?
Oh, well, if you bought, for example, this bar here, you're buying it at the prevailing interbank spot price plus 1.5%. But your original question was all about this scaling of the physical against the paper. You're right to be concerned by it, but you have to understand how we got there in the first place. Back in 1974, your own company, IG Index, was originally Investors' Gold Index. It was a derivative of gold to allow investors to get into it. And nothing's new in that, no disrespect, but we've had other derivatives of the gold, including futures and options, that allow people to efficiently gain exposure to or hedge their position to gold. Miners couldn't mine without a futures market and a forward market. So this leverage that occurs is a necessary medium to allow producers and consumers on both sides to hedge. Added to that, you've got speculators who are then enjoying that leverage in there. And unfortunately, that side of the market's grown very, very large and is now leading the market. So in short, railing about this is like railing about the weather. It's a necessary component of what we live with, and you ain't going to change it, probably. The scaling on it is unfortunate. It's got out of whack, definitely at 200 to 1, but I don't know what you can do to scale that back.
And you store gold, don't you, for your clients? Have you noticed an increase in the number of people wanting to store physical bullion that they are buying?
Oh, absolutely, coming out of the ETF and coming into physical. Let me give you a small anecdote about just how much of a problem this is. Across the UK, we estimate there's somewhere in the region of 2 tonnes. The UK is a small market at a retail level for gold. Forget about the wholesale market. At a retail level, we're 0.3% of global physical demand in the UK, small. 85% at the wholesale level. But at the retail level, we estimate there's about 2 tonnes of gold coins and bars in a small size available to you to buy. That's just say there's about £1 of gold per person. Were there to be some seismic event or geopolitical event, you ain't going to get it, in short. That market's going to get dried up very quickly, and it'll take some months. It's happened twice in the last 15 years where physical supply is completely dried up for months. So it's a very thin market. It does underscore the danger of having this massive scaling of physical to paper. And the physical market is a thin market. There's no question about it.
Yeah. Let's quickly go back to some of the questions, if I can. Now that gold is used less as a safe haven, why should investors buy gold? We sort of touched on this as well during the interview. It's not as what it was, is it, gold?
No, I mean, there's a great quote in a recent article I read that basically said the risk of not owning gold is greater than the risk of owning gold. And I think that's a very good takeaway, that people.
You don't want to get left behind, basically.
You don't want to get left behind. I mean, Ross's comment about the market drying up. If, and there's a huge if there was an event that caused a huge demand for physical gold, you don't want to be left with nothing. So I think that just having a very small allocation in your portfolio to gold makes perfect sense.
Yeah. Ross, one for you. Is there a bubble in the stock? Is there a bubble in the stock market? Don't want to get too much into that. And if so, and it bursts, what would be the impact on gold? I mean, we're very close to, in some markets, to being in bear market territory, a 20% drop, and we haven't seen gold rise that much.
We haven't. Yeah.
So if there was talking about some event, is a slump like we saw in 2008? Going to generate the 2,000 again on gold, do you think? Is that potential?
First of all, going back to the point about safe haven, gold does not have a monopoly on that ownership, and the dollar has been the safe haven, particularly in the tariff talks that we've had. So gold hasn't seen those wins that we might have expected. In short, where do I see? Sorry, your question again. I've lost it there.
No, well, it was a question as to where we go, the bubble in the stock market. If it bursts,
forgive me. Absolutely.
What sort of effect would it have?
Yeah, I mean, the equity markets, the S&P's lost almost its entire gains on year to date, and has the Dow Jones.
But the gold price hasn't risen that much.
No, gold responds to equities, it responds to the dollar, it responds to inflation, it responds to geopolitical tension, but not unilaterally also. Gold will tend to look at one item and it will focus on that. Currently, most of this year, it's been the US dollar. Dollar's up 5% year to date, gold is down 7% year to date in dollar terms. That's it in a nutshell. To get onto the radar and shift from the dollar onto the next subject, inflation, should it get to, inflation needs to get consistently above 3.5%, then it's on the radar. We'll no longer consider other things. Equities have not been on the radar. It doesn't respond to all things equally. If you have a seismic correction in the equity markets, a 15%, absolutely. Perversely, gold would probably go down with equities in the short term. Why? It's a very liquid asset. If you've got margin calls, you'll probably sell your profitable gold positions to pay the margin calls, and then gold will do a J-curve and come higher again. It's done that before. At the moment, the correction we've seen in equities is not sufficient to distract us away from the dollar market and other things.
Yeah, we've spoken about. Sorry, go on.
Yeah, what I was going to say is I completely agree with Ross. I mean, what tends to happen if there was a market correction in stocks, you'd probably see that the gold stocks follow the main market and head south before the price corrected and the stocks go north again.
Look, we've spoken a lot of in the last 5 or 6 years. We've spoken a number of times, and we've had this period of quantitative easing. It's very loose monetary policy. Inflation hasn't picked up. Gold hasn't picked up. Yeah. We're in a new normal. Why gold? Let's just quickly round this up again, because I just feel that we haven't really necessarily nailed it on the head as to why gold hasn't recovered. I mean, there's all sorts of speculation as to when it could rise. Inflation's not going up. Gold's not going up.
Well, I mean, going back to the uncharted territory, I mean, as you rightly say, QE has been massive over the last few years, but now we're in QT. QE is going into reverse, and we're in the very early days of QT. And I think next year, with the Fed rate going up, so interest costs on this huge debt going up materially, and sort of liquidity being sucked out of the market with QT, that is when we really do, rather than put a toe in uncharted territory, we put a foot in uncharted territory, and I think that is where the gold price could benefit.
Ross, final comment?
Gold is characterised by 7-year bear runs. We've just had a 7-year bear run. A lot of players in the market are deeply despondent, horribly so, and if you wanted to get into a market and you wanted to look for blood on the streets, we're nearly there. The best thing about gold is that we're just like the late 1990s, where we're just the same. The market looked dire, central banks were selling it, and then 2000 came, and gold then got onto a 16% year-on-year clip because certain things happened. What I'm saying is you're a little early to be investing significantly in gold at the moment, but we're not too far. The market seems to be finding a bottom. What I can't today tell you is what that new gold buyer looks like. Is he a central banker? Is he an investor? Is he an inflation hedger? Is he an asset allocator with a hedge fund? I don't know, is that. But the background is in place for the formation of a bull run. We just don't have all the components lined up just yet.
Yeah, okay. Mindful as well of that comment by James Bevan earlier in the show. But gentlemen, look, thank you indeed for joining us. To our guest today, Simon Popple from Brookfield Capital, and from Sharps Pixley, Ross Norman. You can continue with the discussion on the IG community, on the IG community chat thread. You can find that at community.ig.com. Our next IG commodity chat is this time next week, 1 p.m, Thursday, 29th of November, and it's all about the oil market ahead of the 175th meeting of OPEC. My colleague Sarah Walker will be in discussion with our guests, including Malcolm Graham Wood, founder and managing partner of Hydrocarbon Capital and author of malkiesblog.com, and Spencer Welsh. He's the Director of Oil Markets and Downstream Energy at IHS Markit. And that's it for today. As I said, do join us again on the chat room on IG, and you can continue to formulate and put to your questions to a moderator on that particular platform. And again, join us next Thursday at 1 p.m.